Good afternoon and welcome to the Lookers PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab, which is situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand over to Mark Raban, CEO. Good afternoon, sir.
Thank you very much. Good afternoon, everyone. I'm Mark Raban, CEO of Lookers. I'm joined this afternoon by Oliver Laird, our Chief Financial Officer, and Duncan McPhee, our Chief Operating Officer. It's a great pleasure and opportunity to have be joined by you today to outline our December 2022 full year results. And we'll take you through some selected slides of the presentation that you can see on screen now. So I'll start by giving an overview summary. I think continued excellent performance really overall. A very good year for us last year. Underlying PBT coming in at 82.7 million. And that's a very strong comparative result versus our record year of 2021. Which, as you can see, included 9.8 million of COVID support. So adjusting for that, we have another record underlying year. That was achieved against the context of some pretty strong headwinds throughout last year, including things like supply disruption and a lot of the economic uncertainty, increasing interest rates, and the whole plethora of issues that you'll all be aware of. I'm very pleased with our after-sales performance. After-sales, in many ways, is the backbone of our business, and we managed to achieve revenue growth there of approaching 7%. A very good result. Our gross margin was overall at 12.8%, and that was broadly level versus the prior year. Very pleased with that performance, particularly in the context of some very, very strong comparatives in 2021, particularly in half two, when you may remember that used car values started to increase materially. We've been doing our level best to manage all the cost pressures that every business and every individual is facing. We managed to contain our underlying operating expenses, excluding COVID, to 7.5%, and I'll take you through the key components of that in a second. Really pleased with our dividend, 3p overall for the year, up over sort of 20% versus 2021. And the good news continues into this year, and we're very pleased that Q1 has been strong for us. And you'll have noted that recently all our full year expectations have been increased by the various analysts that cover us. This is the profit bridge for last year. Last year, when you exclude the impact of COVID grants, was at 80.3 million. You can see that gross profit was up by 6.5%. Great performance coming through on new cars. Used, as I already alluded to, a bit of pressure there coming through both volume and margin. After sales, the backbone of the business, up by 10.5 million, very good performance. And our fleet and leasing businesses continue to perform well, with 1 million added there in terms of GP. You can see that the costs are up 7.5%, as I've already said, and you can see the key components of it there. Pressure on staff costs and utilities in particular being the key issues. I was actually very pleased with our finance costs, which, when you think they were achieved against quite an increase in base rates particularly through the back end of last year. Oliver will cover this, but you'll see we've managed to liberate further working capital and turn that to cash, which has definitely helped our interest costs. So I think that all adds up to a very strong position in a rapidly evolving market. I'm going to take you through our strategic priorities in a minute, but we have real clear clarity about them, and they're all focused around self-help initiatives, which we think is the thing to do. And we are, continuing to gain demonstrable momentum on execution against those, so we can clearly point to progress that we're making. We've got great OEM relationships across the board. We've got over 35 brand partners, and we've managed to form some scaled new relationships over the last 18 months as well. I'll touch on those in a second. And I think very important to say that we do have a balanced portfolio. It's very well balanced between volume and premium brands, covering over 90% of the UK new car market. And that positions us very well, both to deliver on existing organic growth, but also acquisition-driven growth as well. And we've got a good balance sheet in order to do that. Oliver will touch on that, but cash and property now equivalent to 92 pence, which also positions us well to be able to respond, we think, to what is going to be the biggest change in a generation, which is the continued acceleration of battery electric vehicles as they gather further momentum. So I will just give you a quick overview of our strategic priorities. We have 6 of them. There's nothing new about these. They've been with us now for the last 18 months or so. I won't say too much about them individually, other than I did want to say operational optimization in the top right of the tyre is really the foundation stone for us. It's about doing the everyday things of automotive retail better, faster, quicker, and more efficiently, with a focus on cost in particular, because that's very, very important in a low margin business. So what have we been up to then in terms of our 6 strategic priorities? In terms of operational optimization, we've been making some very good progress there. The things I'll call out to you are particularly, I think, our progress on delivering service plans and used car warranties. As you can see from the slide, we sold 31,000 used car warranties compared to 12,000 in the previous year. You'll also see that we've got 163,000 live service plans out there, and we're continuing to increase our penetration of those products. We've had further improvements in our used finance penetration. We're now managing to see our penetration at over 50%. And that's driven additional income during the year of 15.7 million. And as I mentioned right at the start, the attention to detail around stock management has driven out a further 32.1 million of cash flow benefit. So I think some really strong progress around our key optimization initiatives. We're continuing to leverage technology and digitization opportunities. You may have heard us talk before about the need to harmonise our dealer management system. It's very important that our entire portfolio gets onto one dealer management system. We've now managed to transition 3 quarters of that, so we anticipate finishing the balance of that job back end of this year, maybe early next year. Our sales transformation plan is on track. Those of you that have seen our brand advertising on TV will know that our very strong belief is that the market will converge around an omni-channel customer offering. There's always going to be people that want to buy purely online, but in our view, they're few and far between. Most people want a combination of a physical and tech-driven experience. And we're making significant progress in our digitisation program in after sales at the back of house, including digitalisation of job cards and working on productivity and efficiency. Very pleased to welcome some new brands. This is item 3 to our portfolio. We've welcomed BYD. For those of you who don't know BYD, they're the world's biggest producer of electric vehicles. We've also welcomed Aura, that's Great Wall Motors. We've welcomed Polestar, an expanded relationship with them, and we have MG and Lotus. So some real successes there in terms of new brands. On existing brands, we've now successfully migrated across Mercedes-Benz to our new agency model, and that's proving very successful for us. So we're pleased with that. Just to quickly finish off, in terms of the increasing penetration of the used car market, we've now completed the design and development and prototyping of the Lookers Car Hub. We'll be running that from an existing site in Middlesbrough. We're just waiting planning approval for that. As a result of using the existing site, we've managed to drop the capex, which is great news, 5.6 million. And that supports an attractive return from multiple revenue streams, including vehicle sales, vehicle servicing, charging, and experiential elements added to the proposition as well. So depending on how that goes later this year, we think there is scope to roll that out further, which we're very, very excited about. In terms of after-sales revenue streams, and in terms of developing those, I think it's no surprise that battery electric vehicles offer some challenges in terms of after-sales. There's also some opportunities as well. So we're looking how we can make our after-sales revenue streams sustainable, elongated, and with real growth prospects. And we've entered with gusto the cosmetic repair market. So by the end of this year, we will have 30 mobile solutions on the road. You can see there the vans, and we'll have 49 fixed sites. Very excited about that in terms of what that is going to do for us. It's a big market. It's got good margin dynamics around it, and it's hugely fragmented. And the last thing I just wanted to draw your attention to in terms of our strategic priorities, that's to leverage or continue leveraging our corporate customer base. We have a number of corporate businesses that you can see there. We've now brought them under a single umbrella, Lookers Vehicle Solutions brand. We've acquired 4Ways, which is a great little acquisition for us, which adds new product capability in medium-term B2B leasing, which we're very pleased with. And the whole idea here is that we will have a complete suite of integrated products that we'll be able to sell into our corporate customers. That really concludes my review of the sort of strategic initiatives. I'll summarise by saying, good solid progress on all of them, all moving in the right direction, which we're very pleased about, and starting to show tangible results. So Oliver, perhaps I'll hand to you then for a quick overview of the numbers.
Thanks very much, Mark, and likewise, welcome everyone. I hope you're having a good afternoon. Mark has covered most of the P&L impacts, so what I thought I would do in this section was just cover a couple of slides talking about the balance sheet, but then most importantly, capital allocation, how we look at capital allocation, and how we're doing it against our stated aims as far as that's concerned. So, looking at our balance sheet, I think it's safe to say, our balance sheet does continue to strengthen. We've also seen our facilities increase throughout the period in terms of our RCF. Our inventory levels have increased as well, but that didn't really impact our working capital that much, as we managed to offset those through an increase in our consignment vehicle creditors as well. Our stocking loans are roughly about 79% of our goods for resale. And as I said, we've added new funding facilities to help support growth in our leasing and fleet businesses and provide us with a solid platform for strategic growth in other areas as well. Probably most importantly, we saw our pension deficit shrink by about 20 million. We continue to make contributions to that deficit, and there was an increase in corporate bond yields, which also supported the improvement. I think you'll probably all remember the impact after the government's mini budget over last year, and that indeed ended up with some pension schemes suffering liquidity shortfalls. I'm pleased to say that Lookers was not amongst those, and we weren't materially affected, and we did maintain a strong collateral buffer. And as you can see, all of that, together with the trading performance that Mark talked about at the beginning of the presentation, actually led to an improvement in the equity value of our company that we see here. So then moving on to the next part of the presentation, I'd like to talk a little bit about our capital allocation policy. So in the early part of last year, we made an announcement in terms of our group strategy and also in terms of our capital allocation policy. So I suppose the question is, how are we doing against that capital allocation policy? And that's what this slide shows. In terms of leverage, our policy says that we'll be a target range of plus or minus half a turn of EBITDA. And as at the end of 2022, we will get within that range at plus 0.41 times EBITDA. I think that says that we have the balance sheet now to support and pursue good organic and inorganic growth opportunities. Moving on to CapEx. In terms of CapEx, we have a range of between 10 and 15 million for maintenance CapEx, and we are in line with that range. And indeed, what we also chose to do was divert some of our CapEx spends to improve our existing facilities in terms of dealerships, but also to build some new dealerships. I think if we move on then to talking about the dividend, we were very pleased in 2022 to have recommenced paying a dividend as part of our capital allocation policy. And at that point in time, we set out our coverage ratio target. And the coverage ratio target that we wish to achieve over the medium term is 3.5 to 4.5 times earnings per share. I think that we will aim to progressively grow the dividend over the coming years and move towards that. And as the automotive sector starts to normalize, we will steadily bring ourselves down from the position of circa 6 times earnings per share that we're at today into the 3.5 to 4.5 times earnings per share region. So then if I can finally just talk about the position with regards to shareholder returns. So we paid a full year dividend of 3 pence, and that was an increase of about 20% year on year and was in line with the market consensus. And that meant that effectively we've returned about 13.7 million in relation to that year to shareholders. The total return was 18.2 million, and we commenced a share buyback, which led to a further 4.5 million as of last year. We are nearly through that buyback. In total, we expect that to be about 15 million, and we'll anticipate it finishing in the next 2 to 3 months. So I think the summary here is that we have a disciplined approach to capital allocation policy. We will always look at things in terms of maximizing the long-term shareholder return, and we'll always look at things in terms of the value it generates and ensuring that it's value accretive to our shareholders. So that's a summary of what I wanted to give in terms of the financial performance of the business. I'll pass back to Mark now to finish out the presentation. Thank you.
I think
Mark, mute.
Oh, I'm back on. Thank you. Apologies for that. I think that really everyone concludes the formal presentation. I'll summarise at the end, but I think probably now very happy to go to questions.
Perfect, and thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. And Mark, if I could just hand over to you to read out those questions, then I'll pick up from you at the end.
Thank you. Duncan, I think we've got a question here for you. Will Car Hub mainly retail part exchanges from across the group, or rather source its own supply independently of the rest of the group?
Thanks for the question. In terms of stock sourcing, the group has got a rich kind of franchise mix of premium and volume brands, and we do generate a huge amount of our own part exchanges, and so some of the stock will come from there. We've also got a big fleet and leasing business, and that fleet size is growing, and that's deliberate in terms of generating stock for the car hubs, which really becomes an integrated business. But as well as that, it will have access to third-party sites like Motability, OneLink, some of the OEM platforms. So yes, I mean, it will source its stock from multiple channels.
Good, thanks, Duncan. Next question. Lookers forecast return on sales, that is PBT margin of around 1.5%. Seems better than some peers like Virtue. What's driving this relatively strong profitability, and can it be sustained? I think, Oliver, if you and I sort of double act our way through this, I mean, if I start, I think that there's a couple of things that help us in terms of driving our return on sales. I think one is our brand mix. We do have a well balanced mix of brands which we represent, with quite a lot of premium and mid-range brands in there. And I think having that premium mix in there is particularly helpful in terms of driving a return on sales. I think the other thing I'd say that's particularly helpful is that our property portfolio is largely freehold based, and therefore, in terms of rental operational gearing, we're at nothing like some of our peers. So I think that's very helpful to us. And I think the third thing I'd sort of pull out is that I think, in terms of our operational optimization agenda, in terms of driving those ancillary product sales, which have got good levels of property, things like driving cosmetic repairs, which are higher margin, driving those after sales numbers. In my summary, I mentioned 7% of after sales. After sales is a very, very profitable part of our business. I think by focusing on all of that, that's helping us, drive those returns. Oliver, I don't know if I've covered everything or whether you want to add anything, but I'll hand to you.
But no, Mark, you've absolutely covered all the main drivers in terms of what's delivering that. But I will say also, let's just say our peers are doing well as well, and we're supportive of ensuring that the entire market is continues to move forward.
Okay, thank you. I've got one here, I think, on acquisitions. So what does the pipeline of new opportunities look like with regards to partnerships? And can you talk a bit more to your headroom for further acquisitive growth with all existing brand partners, as mentioned in the full year results, RNS? So Duncan, let's you and I do that. I think the pipeline of opportunities is pretty strong at the moment. There's a lot of change going on in our industry, including electrification, moving to agency-related models. And when you look at how fragmented the market actually is, and I think probably about 80% of the market sits outside of the top 6 or 7 dealer groups in the UK, and that's a high level of fragmentation, which is held in small groups, mid-sized groups, and individual operators. I think all of those groups will be looking at some of this change, particularly if there's not strong succession in the business, if these are family businesses. And on the back of a good couple of years, I think some of them are likely to be saying, well, actually, probably now is not a bad time for me to exit, because we're not really up for all of this change. So I think the pipeline is strong in terms of the headroom that we have for further acquisitive growth. When you look at all our brand partners, even in our biggest relationships, we probably only represent 10-11% of the UK network. And I think the trend across most OEMs is one of network rationalization. So working with fewer, better, well-financed partners. And I think that does offer a significant opportunity for us. So I think we have headroom really across all our brands. And of course, in terms of new brands, there's 25 new EV brands planned for the UK coming in from China. We won't be partnering with all 25, so we have to choose our relationships carefully, but there is a big opportunity there, as we did with Polestar, helping Polestar establish themselves in the UK. So Duncan, is there anything you want to add in terms of acquisitions and headrooms?
Yeah, I think that the only bit I would add, Mark, is that, in terms of brand relationships, we value our brand relationships very much, and we work particularly hard with our brand partners to have a real, close and collaborative relationship. We focus really hard on doing a good job for the brand, and that puts us in a really, really good position to grow further with those brands. So yeah, that's the only bit I would add, Mark.
Okay, thank you. Another question here. I think probably Oliver, this is one for you, if you wouldn't mind. How often is the property portfolio revalued, and would you look to redevelop sites for alternative uses if trading wasn't in line with expectations?
Thank you, Mark. So the property portfolio is valued on a net book value basis. That's our accounting policy. We do look at market valuations on a biannual basis for internal use within our property strategy, and we have a very clear property strategy that's been established and they're executing upon. We clearly, first and foremost, are a retailer and servicer of vehicles, and our property portfolio is focused on doing that and delivering that to the right degrees, the right levels, and the way in which the OEMs expect us to deliver. However, that being the case, we're also mindful that roughly around 75% of our portfolio is freehold or long leasehold. And where there are properties that are excess to requirements, or we can find uses alongside the OEM requirements, then we will do so. So again, it's all about the value to all of our stakeholders, our shareholders, and our property strategy aligns with that. I hope that answers the question, Mark.
Thanks, Oliver. Yeah, I mean, there's just one thing I'd add to that. I mean, I think, with our freehold property base, I think we are really well positioned to be able to respond operationally to the changing demands of the market. I mean, we are seeing now some dual franchising of properties, which is good to see because it helps share overheads and occupancy costs. And when you have a freehold property portfolio, much easier to make those changes quickly and cost effectively without having to have landlords involved. So I think that there's clearly a financial benefit of the freehold property portfolio, but there's a very clear operational benefit as well. So thank you for that question. I think this is probably one for you, Duncan, if you could. Are there any plans rediversifying into complementary areas, i.e. EV charging?
Sorry, just taking myself off mute. Short answer, yes. So part of Car Hub, we're going to have on that site 6 superchargers, 150 kilowatt chargers. As an example of what's planned in the future. So we'll definitely look at our estate and where we can optimize that through EV charging, whatever we would do. I think there's already examples of diversification. So as Mark spoke about earlier, cosmetic repair, we see that a big opportunity within cosmetic repair and rolling that out. And that gives us access to our internal preparation of stock, our insurance product, minor damage protection, and also to the retail opportunity. We've got tens of thousands of customers coming into our after sales business. Some will have scuffs in their alloys, scratches in their bumpers, and we can optimize that opportunity through that channel as well. We've just completed an acquisition of 4Ways, which gives us access to the rental channel. So that there's lots of things that we're looking at as a group to diversify, but very much within automotive.
Thank you, Duncan. I've got a question just come in. I think it's a financial type thing, Oliver, for you. Dividend, share buyback, or M&A? What's the preference?
Thanks, Mark. I think we've got a very clear capital allocation policy, and all of those things are considered within that. And as I say, it's all about maximising long-term shareholder return. So if there's an M&A opportunity that we believe will do that, then we will seek to do that. Likewise, we've also stated that we have a dividend policy, and we're seeking to grow that dividend progressively. So that will continue. And where we go through that capital allocation policy and we see that there are other returns, there are excess capital potentially, for example, then we'll look to do additional shareholder returns. The current share buyback is an exact example of that, where we looked at the capital allocation policy, looked at the share price as it stood, and looked at our property portfolio, and saw the best way to return value to shareholders was via additional share buyback. So all of those things are part of our capital allocation policy. We will do all of those things over a period of time at different points of time with a view to that disciplined approach to capital management, capital allocation, and maximizing long-term shareholder returns.
Okay, thank you, Oliver. Now, if my technology skills are up to scratch, I'm not seeing any further questions.
Mark, they certainly are up to scratch, and thank you very much. You've managed to address all those questions from investors, and of course, the company will review all the questions submitted today, and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Mark, could I just ask you for a few closing comments?
Yeah, absolutely. Well, I mean, the key points I just wanted to summarise are on the slide in front of you. I think hopefully we've managed to show that we've had another excellent financial performance, building on the record performance in 2021. It's great news. I hope we've managed to demonstrate that we have a real sense of clarity around our strategic priorities, and that more importantly than anything, we are making progress on execution. We've touched on during the Q&A our strong OEM relationships. We've got headroom to grow across the board, and we have a whole plethora of new and exciting relationships waiting to be formed. Oliver's looking after the balance sheet very, very well, and we've got the balance sheet to support those growth aspirations, and we've had a very, very good start to this year, which I think positions us very, very well for the remainder of 2023. So with those closing thoughts, I'd like to thank everyone for joining. Thank everyone for their questions. We absolutely always enjoy these interactions. It's always great to have. And as I say, we will publish answers. And if there's any more questions at any point, you can always reach me through Lucas.
Mark, Oliver, Duncan, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Lookers PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.